Right now, some plain vanilla G-Sec mutual funds with zero equity and zero credit risk have just delivered 12% annualized return. This is in the last 1 year. In fact, you can see this chart here. The highest is 12%. Middle of the rack mutual funds in this category have delivered 11%. Even the funds in the bottommost have delivered like 10%. Meanwhile, the average equity funds, its portfolio PE of 30 translates to an earning yield of barely 3.3%. So equity funds are delivering a yield of 3%. So let's be honest, who's a fool here? Are we lining up for disappointment by pouring cash into overvalued assets such as say stocks or even mutual funds of equity nature, while risk-free government bonds are paying 3 to 4 times more than the yield of these mutual funds? Hold that thought for a moment, because in the next 10 minutes, I'm going to unravel this paradox, and I will show you why this math is not the whole story. And most importantly, I will give you a framework to profit without losing sleep. And if you prefer content like this, please consider liking this video and sharing it with your friends. It helps me stay motivated and do more research. So why on earth would you invest in an equity mutual fund that yields only 2 to 4% per annum? And will this phenomenon, that is gilt funds giving double-digit return, be a permanent one? Or is it like a one-time fleeting event? That is not just a question. It's a very powerful argument. And this has been made by billionaires like Jeremy Grantham, Howard Marks, and even Seth Klarman. Right now, you are investing in stocks of mutual funds with PE of 30, 40, or even 100. And that equates to an earning yield of just 2% or 4%. So are we crazy, or is everybody missing something? The old investing logic is not working anymore. If you think of those old wise logic, you will stay outside the market, which is also proving to be dangerous. And finally, how can you invest smartly despite this very high valuation? So the first part is dealing with the problem. This is the classic PE logic. Here is the classical argument. If the PE of a stock or a mutual fund is 12, then the earning yield is about 8%. That means for every 100 rupees invested, you are getting 8 rupees as earnings. Compare this with government securities or bank FDs. They give you 8% to 12% with almost negligible risk. So if the PE goes above 12, the earnings yield starts dropping below 8%, and the equity asset class becomes unattractive. So why take risk of equity for lower yields? Let's apply this to today's numbers. Nifty PE around 20. That's an earnings yield of about 5%. Check any decent mutual fund portfolio today. The PE of the stocks they hold are 20, 18, 17, 30, 50. Even an average mutual fund portfolio's average PE is 23, meaning a yield of about 4.3%. That is, 100 rupees invested, the company generates an earning of 4 rupees 30 paise. Contrast this with 8% fixed income options or the gilt funds that have given a huge return in the recent past. But here is the paradox. Nifty's lowest PE in the last 10 years was around 19. If you strictly follow the classic framework, you would never be able to invest in equity ever. So, as per this framework, investing in equity right now when the PE is more than 12 makes no sense at all. This is the exact argument made by some very well-known investors. So in the second section, let us understand this paradox. Despite very high PE, equity has delivered phenomenal returns, partly as asset appreciation over the past 15 years. Last time Nifty PE was below 12 was in 2008 during the GFC, that is global financial crisis, when PE was 10.7. Since then, the PE has never again seen such attractive low levels. The lowest in the last decade was around 18, and yet mutual fund SIPs and equity portfolios have compounded wealth like never before. So how is that possible? Because we no longer live in the old world. The market has structurally changed. Let's look at why. In 2010, monthly SIP inflow was under 500 crores. Today, it is 20,000 crores every month. EPFO, that is your provident fund, they now invest part of your retirement savings into this market. That is bringing non-stop inflows. Then you have retail investors who have exploded with Zerodha, Grow, Paytm, all bringing in crores of new demats into this account. Liquidity is seeming to be permanent. Money is flowing in month after month. So even when earnings aren't growing that fast, the price is being supported by a tsunami of huge money chasing limited number of stocks. Some call this the greater fool theory. People buying overvalued assets. They are assuming that somebody else will buy at even a higher price. But is that what is really happening? Or is this the new normal of investing where flows, behavior, macro structures, all this matter more than valuation? This continuous inflow of funds creates a liquidity driven demand, and this pushes up the valuation and keeps P very high. So now we are stuck in this paradox. Valuations are high, earning yield is low, and if you wait for the perfect entry, it never comes, and yet the market keeps going up. The third part is the solution. So now the question is, how do you invest in a world where the classical valuation framework does not help you anymore? Should you avoid the market and wait for PE to return to 12 or lower? Well, good luck. It might take years for that. Instead, here is a smarter approach, one that accepts reality, avoids FOMO, and still helps you build wealth. It is simple, but it is not easy. You need to stop chasing just valuations, and you should start following a rule-based framework that works in today's market reality. So the solution is, don't time the market, time your exposure using SIPs to average your cost. Don't pump all your money at once. If valuations fall, your next SIP buys more units. If valuations rise, you're already in the market riding the upside. Second solution is to mix debt, gold, along with equity, that is asset allocation. This is to balance the risk. High valuations mean higher risk, so balance it out. Even a 60-40 equity debt portfolio gives decent return with low volatility. Right now, debt funds, FDs, bonds are all giving 7 to 8%. So why not use that? When equity performs poorly, gold does well. So why not mix both in your portfolio? The third solution is to rebalance based on valuation signals. Don't exit completely. Instead, when market gets expensive, shift some equity into debt. When markets correct, increase your equity. This is systematic risk management and without prediction. I've done a full video on how to rebalance based on the market signals. Please do watch it here. The fourth solution is to focus on quality and momentum. Not all high PE stocks are bubbles. Some command higher premium for a reason. So rather than avoiding high PE blindly, focus on funds or strategies that combine quality businesses with earnings growth and momentum. That's where modern alpha is being created. Some companies always trade at high PE, but they grow faster. Funds that focus on quality plus earnings momentum still can create an alpha, even at these elevated valuations. Third solution is to think long term. Think in decades, not months or years. Markets may stay expensive for years. High valuations may slow down returns in the short term, but over a 10-year or a 15-year, markets will still reward discipline and patience. India's economy, earnings growth, and innovation are still compounding. Over 10 to 15 years period, staying invested will beat every strategy, including sitting on cash waiting for the perfect valuation. Let me leave you with this very interesting story, a story of perhaps one of the greatest fund managers that Wall Street had ever seen, Stanley Druckenmiller. He was a legend. His fund posted an average return of 30% without any money losing year in a decade. And yet in 2010, he did something unthinkable. He walked away. He closed his hedge fund and returned the money to his investors. Why? Because the market had changed. He was managing billions of dollars and the fund flows were enormous. Money was pouring in relentlessly. he felt the pressure. Too much money chasing too few ideas. The valuation discipline he had built his career on just did not seem to work anymore. Everything looked very expensive. Everything was crowded. He once said, I felt I couldn't generate the returns that justified the stress. So he shut down his fund. The legend bowed out tightly. But here's the twist in the tale. Markets did not crash. In fact, they soared. From 2010 until today, the same market that he exited has delivered double-digit compounding returns for investors, in spite of the fund flows increasing multiple times, because the world has changed. This wasn't just about value anymore. It was about flows, liquidity, global central banks printing money, pension funds, SIPs, sovereign funds, EPFO, index funds. Everybody is throwing in money month after month, year after year. Perhaps is the greater fool theory the new normal? Now, does that mean valuations don't matter? Of course not. But relying purely on valuations like P/E ratio can lead to decision fatigue. It can lead to missed opportunities and constant stress. The world is not perfect. Markets are not rational. Tell me in the comments, do you still believe in the old P/E logic or have you adapted? If you like this video, please consider hitting the like button, sharing it with your friends and subscribing to this channel.